In this video clip, I'm going to look at the consolidation adjustments required for a situation where we've got unrealized profit sitting in the closing inventory, the unrealized profit being from a group perspective. So I'm going to use one of the tutored questions, question 1713, and just have a look at the intercompany transaction regarding inventory. Now, the question told us that Laura, the parent company, sold inventory to their subsidiary Jade for an amount of $20,000, which means that in the accounting records of Laura, they recorded sales of $20,000. The original cost to Laura of this inventory was $18,200. So from a group perspective, that is the cost of the inventory. Half the inventory was sold in the current year for $12,310. So from a group perspective, once again, this represents our realized sales. Now, you know, the aim with our consolidation adjustments is to adjust the combined results of the parent and the subsidiaries within the group, so that in the end we sit with a set of results that represent only the group's interactions with external companies or external parties. So only the realized profit from dealings with groups or companies outside of the group structure. So with our consolidation entries, we want to adjust or reverse any intercompany transactions. Before looking at the actual adjustments, let's first of all just have a look at what is recorded in the accounting records of the individual companies. Now, Laura, being the parent company, they've recorded the sales transaction of selling the inventory to their subsidiary. So their inventory would, with regards to this specific transaction, show a balance of 0. They would have recorded sales of $20,000, and they would have recorded a cost of sales, which was the original cost of this inventory, of $18,200. Jade would have recorded a purchase of inventory for $20,000, but because half of the inventory was sold, they sit with a balance of $10,000 in closing inventory, as well as $10,000 transferred to cost of sales to record that selling of half of their inventory to an external party. And the sales that they've recorded on that transaction was $12,310. From a group perspective, the intercompany sales transaction never occurred. So from a group perspective, the cost of the inventory is not the half of $20,000, but actually the half of the original cost of the inventory, $18,200, because from a group perspective, that was the original cost when the inventory entered the group structure for the first time. So if we've got half of the inventory left at the end of the financial year, the inventory that should be included in our consolidated results is for an amount of $9,100, which is half of the original cost, $18,200. So therefore, to adjust our combined value of inventory, which is in this case now the 0 plus the 10, so $10,000, to what it should be from a group perspective, $9,100, we have to make a credit adjustment of $900 to inventory. And an alternative way to look at it is to say that in Laura's accounting record, sales of $20,000 was recorded, cost of sales was $18,200, so there was unrealized profit on selling inventory of $1,800. Half of that has now realized through the sales to the external parties. So it means that inventory had another $900 that it was overstated from a group perspective because it included an unrealized profit on an intercompany transaction. So therefore that $900 needs to be reversed out of inventory. In any case, that 900 adjustment filters through to the journal entry that we pass on consolidation. The second item is then the sale. So I've already said from a group perspective that intercompany sales transaction never occurred. So from a group perspective, the only realized sales was the bid to the external companies. So we want a sales figure of 12,310 in the consolidated results to adjust our combined sales, which is in this case would be the 20 plus the 12. It's 32,310. To get it to the 12, we need a debit entry on our sales line item of $20,000, which you then see in our adjusting entry on consolidation. If we look at the cost of sales from a group perspective should have been half of the original cost of the inventory, which was 18,200, because half of that inventory was sold. So from a group perspective, we want a cost of sales of 9,100. Recorded in the parent company was 18,200 when they recorded the full sale of the inventory to the subsidiary. The subsidiary recorded cost of sales of 10,000, which is half of the 20,000 at which they carried the inventory. But we only want a figure of 9,100, which reflects the cost of sales to the group. So if we want to adjust the 18 plus 10, the 28,200 to get to 9,100, we need a credit entry of 19,100. And that is what we see in the adjusting entry. So this is a good example to see that the consolidation working entries, the purpose of that is to adjust the combined results of the individual accounting records to what the result should be from a group perspective, only incorporating the realized profit figures. Now, because we make an adjustment to the balance of an asset, we've got a deferred tax consequence that we need to adjust for. It is a deferred tax asset. The reason being because the carrying amount of the inventory has been reduced, tax benefits are expected in the future when that inventory is sold. Okay, and the corresponding adjustment to the income tax expense line item.